Welcome to the TAC Index AI Weekend Edition. This is where we blend TAC IP data reports and charts with the latest news in logistics, really focusing in on air cargo. Today, we're doing a deep dive into the most recent air freight market updates. We want to unravel how these shifts in air cargo logistics really connect directly to the broader macro market. We've pulled insights from the latest air freight market update, June 23, 2025, from TAC Index, and we've also got key economic analysis from the Wall Street Journal and Reuters. For you, the listener, our goal is simple. Cut through the noise, find those key nuggets of knowledge, and give you that shortcut to being really well informed about the pulse of global trade.
Yeah, because what's fascinating here is how these specific air freight rate movements, they might seem niche, right? But they actually serve as this amazing barometer for global economic health, even geopolitical events. We'll look at the data, connect the dots, see what it really means for you.
Exactly. So what does this all mean for air cargo this week? Let's jump in. Okay, so first off, the overall global picture. According to TAC Index, global air freight rates actually edged slightly lower last week. The global Baltic air freight index, that's the BAI 0, it slipped by just minus 0.3% in the week to June 23rd, which leaves it about 6% lower over the past 12 months.
And this raises a really important question, doesn't it? Why did rates dip even slightly when, the sources are also pointing to ongoing disruptions? Our sources note this overall decline happened despite some pretty significant factors, things like flight disruptions, cancellations across the Middle East due to the Israel-Iran conflict. That should reduce capacity.
Right.
And there was even a rise in spot rates on some of the busiest lanes out of China, plus, importantly, a rise in jet fuel prices.
So it's complex. Definitely not straightforward.
Exactly. It tells us that maybe overall demand is currently a bit softer, even with those supply-side issues. It's a really complex picture.
Okay, so that's the global view. But here's where it gets really interesting, the regional breakdown. It is definitely not a uniform trend globally. Let's start out of China. Overall rates there were slightly lower again. That's for both U.S. and European destinations. However, specifically, the index for outbound routes from Hong Kong, the BAI 30, that was actually higher by plus 0.4% week over week.
Okay, a slight bump.
Yeah, slight. I mean, it's still down almost 10% compared to last year, so minus 9.8% year over year, but still up for the week. And we also learned that new BAI spot indices out of Hong Kong are set to move from private to public trials from July 1st.
Oh, that's actually quite significant. For anyone tracking this closely, having those spot indices go public, well, that means much better transparency, real-time pricing data becoming more accessible.
Yeah, definitely levels the playing field a bit.
It really does. Less guesswork, potentially fairer pricing.
But then, in contrast, you look at outbound Shanghai, the BAI 80, that dipped by a notable minus 2.7% week over week, and it stands at minus 8.5% year over year.
So Hong Kong up slightly, Shanghai down more significantly.
Right, within China itself.
Well, if we connect this to the bigger picture, that differing performance, it just highlights the microdynamics at play. It's not one single China market. Maybe it's different industries or specific demand patterns coming out of those hubs. Hong Kong, perhaps more high-value goods, electronics. Shanghai, maybe broader manufacturing. It's hard to say definitively from just this, but it shows the nuances.
Makes sense. Okay, moving over to Europe. Rates there were firmer overall, and this includes the transatlantic lanes heading to the U.S., as well as roads going east to China and Japan. Frankfurt, the BAI 20, saw a pretty significant gain, plus 5.7% week over week. That actually puts it ahead year over year now by plus 2.7%.
That's quite strong out of Frankfurt.
Yeah. Now, London Heathrow, the BAI 40, it fell back a little bit by minus 5.2% week over week, so it reversed some of its massive gain from the previous week. But, and here's the kicker, it's still ahead by a very healthy plus 20.8% year over year.
Wow. Yeah, that London figure is quite striking, isn't it? Plus 20% year on year.
It's huge.
Even with that weekly dip, that kind of long-term strength suggests maybe a strong underlying demand, or perhaps a structural shift for that particular hub over the longer term. Could be specific trade flows like pharma or luxury goods.
Interesting. And finally, from North America, rates were also higher on lanes to Europe and to China. Slightly lower week over week going to South America, but they remain well ahead on those lanes year over year. Chicago, the BAI 50, gained plus 2.1% week over week.
Okay.
Though it's still lower by minus 4.6% year over year.
Right. So these regional variations really underscore that while, yes, there's a global average, the specific supply and demand conditions for different trade lanes can vary pretty dramatically. You see these different pockets of resilience or weakness.
Okay, so we have this regional patchwork. But how does this connect to the bigger economic picture? Let's try to connect those dots now. Our sources indicate the geopolitical situation in the Middle East, specifically that Israel-Iran conflict, was a factor in air cargo disruptions. Tank Index mentioned that. However, both the WSJ and Reuters are reporting that the Israel-Iran ceasefire continued to hold, which led to, a degree of cooling tensions.
And that cooling of tensions, it also impacted oil prices. After a 3-day sell-off, oil prices nudged a bit higher, but analysts expect them to stay relatively subdued, as long as energy infrastructure or shipping through the Strait of Hormuz isn't attacked.
Right, a big if.
A very big if. And the TAC index report specifically mentioned a rise in jet fuel prices alongside those spot rate increases we talked about. It shows how directly these global events can feed into operational costs for air cargo carriers. Higher fuel, higher costs. Simple as that sometimes.
Yeah, unavoidable. And tying into the broader market, stocks remain near record levels. S&P 500, NASDAQ Composite, both within, 1% of all-time highs. Tech stocks, especially NVIDIA, regaining its spot as the largest company.
Yeah, it's kind of a disconnect, isn't it? Some underlying softness, maybe in global trade indicators like air freight, geopolitical tension simmering, yet markets are high. But what's fascinating here is the mention of investors being encouraged by efforts to secure trade deals.
Oh.
This ties directly back to those uncertainties on tariffs and trade that TAC Index noted in an earlier monthly update. It's not abstract.
Okay.
We're seeing real-time impact. Look at FedEx. Their shares slid 3.3% after they forecast a huge, $170 million hit specifically from a change in tariff rules. Apparently, it just crushed demand for packages coming from China.
Wow, $170 million.
Yeah. And their rival, UPS, also dropped. So it shows this incredibly direct link between tariffs policy, air cargo demand, and then the broader logistics market and even stock performance.
And this also circles back to the Federal Reserve, doesn't it? Fed Chair Jerome Powell, in his testimony, reiterated that the central bank is kind of well-positioned to wait on cutting interest rates until the inflationary effects of President Trump's wide-ranging tariffs are better known. So tariffs are influencing monetary policy, too.
Indeed. It's all interconnected. Financial markets right now are only pricing in about a 25% chance of a rate cut at the July meeting. But they see a 67% probability for the first cut maybe arriving in September. So this cautious approach by the Fed, combined with these ongoing trade negotiations, Canada, the EU rushing to clinch deals before potential U.S. tariff hikes loom, it all creates this really complex, constantly shifting landscape for global logistics and trade.
Absolutely. So, okay, to bring it all back to you, our listener, we've seen how air freight rates, while slightly down globally this past week, are really a patchwork of regional highs and lows, lots of variation. We've connected the influence of geopolitical events, jet fuel prices to these rates, and critically, seen how broader macro factors like tariffs, trade talks, central bank policy, they're directly impacting demand and profitability for the big players in logistics.
Yeah, this deep dive really shows that air cargo isn't just about moving goods, is it? It's actually a super sensitive indicator of global economic health, supply chain resilience, and, the ripple effects of political decisions. Understanding these connections, well, it helps you navigate this world of constant change, whether you're in the industry or just trying to make sense of it all.
So, as you reflect on this snapshot of the global air cargo and macro market, here's something to consider. How might this continued push and pull of tariffs and these evolving trade deals, coupled with the Fed's cautious stance on interest rates, how might that further reshape the entire landscape of global supply chains in the coming months? Think beyond just air freight. How could it influence capacity and demand for sea containers, maybe even rail and road freight? It could really transform how goods move around the world.
It's definitely an ongoing story, and there's always more to learn.